Silver touched 84.57 today. Tomorrow's forecast is 88.62. By March 24th, the models say $107. But here's what nobody's telling you. COMEX registered inventory just dropped 75% since 2020, and the March delivery deadline is 6 days away. Welcome to the Market Flux. I break down what is actually happening in markets, while the mainstream media keeps you distracted. If you're new here, subscribe right now because what I am about to show you will completely change how you see silver. Let us start with what happened today, February 22nd, 2026. Silver closed at 84.57 per troy ounce. The previous day's close was 77.63. That is a single day gain of 6.94, a move of nearly 9% in 24 hours. To put that in dollar terms, every 1,000 ounces of silver gained $6,140 in a single trading session. That is not a normal day. That is a market screaming something. And according to forecast data, this is just the beginning. Monday, February 23 is projected at $88.62. Wednesday, February 25 is projected at $94.24. By March 12, models are pointing to $100 today, and by March 24th, the target is $107.03 per ounce. That is a potential 27% move from today's close in 30 days. Now, most people are going to look at those numbers and either celebrate or panic. Both reactions are wrong. What you need to do instead is understand the mechanism, because once you understand what is actually driving this, the price targets stop feeling random and start feeling inevitable. Here's the analogy I want you to hold in your mind. Think about a vending machine. You put money in, press a button, and a snack drops out. You assume the machine has inventory. But what if someone secretly removed 75% of the snacks inside and replaced them with sticky notes that say, "I owe you one snack"? The machine still accepts your money. It still shows prices. But the moment too many people try to collect at once, the whole system breaks. That is exactly what has happened to COMEX Silver. COMEX is the world's largest silver futures exchange. It is where silver prices are officially discovered, meaning it is where the price you see on your screen comes from. Traders buy and sell futures contracts. Each contract represents 5,000 ounces of silver. Most of the time, nobody actually takes delivery. They just trade the paper. But right now, something has shifted dramatically. Since 2020, registered COMEX inventory, that is the silver immediately available for physical delivery, has dropped by roughly 75%. It currently sits around 82 million ounces. Here is why that number is terrifying. Open interest on the March 2026 contract sits between 85,000 and 91,000 contracts. Each contract is 5,000 ounces. That represents a theoretical delivery obligation of 425 to 455 million ounces, but only 82 million ounces are available for delivery. March 1st, notice day is February 27th, 5 days from now. If even 20% of open interest demands physical delivery, COMEX cannot fulfill its obligations. That is not a theory. That is arithmetic. Now let me give you the 3 reasons this crisis exists and why it is not going away. Reason number 1 is 5 consecutive years of supply deficits. Since 2021, global silver demand has exceeded supply every single year. The cumulative shortfall between 2021 and 2025 is estimated at roughly 820 million ounces. That is nearly equivalent to 1 full year of global mine production, simply gone. The 2026 deficit alone is projected to approach 200 million ounces. Mine supply cannot respond quickly because silver is mostly a byproduct of copper, zinc, and lead mining. You cannot just turn on a new silver mine. It takes 7 to 14 years. Reason number 2 is industrial demand that is structurally inelastic. By 2025, industrial demand for silver reached 680 million ounces, roughly 60% of total global demand. Solar panels alone consume between 200 and 250 million ounces annually. Electric vehicles added 40 to 60 million ounces. AI data centers, 5G infrastructure, and semiconductors add more every quarter. Here's the critical detail most analysts miss. These industries cannot substitute silver. The conductivity properties of silver are unique. A solar panel without silver does not generate electricity efficiently. An EV circuit without silver does not function at spec. When silver becomes 50% more expensive, these factories do not stop using it. They absorb the cost and keep producing. That is what inelastic demand means, and it means no amount of price increase will quickly reduce this consumption. Reason number 3 is China's strategic reclassification of silver. In late 2025, China officially designated silver a strategic material and restricted its exports. China is one of the world's largest silver producers and historically one of its largest exporters. The moment those exports were cut, the global market fragmented into 3 regional islands, Asia, North America, and Europe, each fighting over whatever local supply they can access. Silver lease rates, the cost to borrow physical metal, surged to 7 to 8% annually. That number matters because it makes transporting silver across oceans unprofitable. The global silver market is now siloed, and each silo is running low. Now here's where it gets interesting, and where the disconnect between big players and retail investors is most visible. While retail investors were being told to be cautious about silver after its 147% surge in 2025, institutions were doing something completely different. JP Morgan's global research, as recently as this month, acknowledged silver averaging $81 per ounce in 2026, an estimate already behind current prices. Emerging market central banks quietly began accumulating silver alongside gold as a monetary and strategic asset. Tech giants, including Samsung and Tesla, reportedly began securing physical silver through direct supply deals, completely bypassing exchanges like COMEX and LBMA. That is vertical integration. That is what you do when you believe the exchange cannot reliably deliver what you need. Meanwhile, retail investors were being fed the standard narrative. Silver is volatile, it is an industrial metal, wait for a pullback. While that story was playing on financial television, 33 million ounces of silver were withdrawn from COMEX in a single week in January 2026, representing 26% of registered inventory, gone in days. The people who understood what was happening were positioning in physical metal. The people who did not were watching CNBC and waiting for a dip. But here is what most people completely miss. The March COMEX delivery deadline is not the end of this story. It is just the beginning of what comes next. Let us go back to the last time silver behaved like this, because history does not repeat exactly, but it rhymes loud enough to hear from across the room. In January 1980, silver hit $49.45 per ounce. The Hunt brothers had cornered roughly 100 million ounces of physical metal. COMEX changed the rules overnight, allowing only liquidation trades. Silver crashed 50% in 4 days. The lesson most people took was silver is manipulative and dangerous. The lesson they missed was different. The physical squeeze was real. The demand was real. The inventory crisis was real. What failed was the paper market's ability to suppress reality indefinitely. Fast forward to August 2020. Silver surged from $11.64 to $29.24 in under 90 days, a 151% move, as COVID disrupted mine supply and industrial restocking began. Again, mainstream media called it a bubble. Retail investors sold. The move continued for another 6 months before consolidating. Both patterns share one structure. Physical tightness builds quietly for months. Paper markets suppress the price signal. Then, one catalyst, a delivery deadline, a policy change, a supply shock, forces price discovery to occur violently and rapidly. We are inside that exact structure right now on February 22nd, 2026. Now here is what has not changed. These are the structural pillars that were true 6 months ago, are true today, and will still be true 6 months from now, regardless of short-term volatility. First, the supply deficit is not closing. Global mine supply is approximately 820 million ounces per year. Demand is approaching 1.2 billion ounces annually. No new major silver mine comes online before 2029 at the earliest. The math does not improve with time. Second, green energy mandates are accelerating, not decelerating. The EU's solar installation targets for 2026 and 2027 require roughly 120 gigawatts of new capacity annually. Each gigawatt of solar capacity uses approximately 1 million ounces of silver. That commitment is locked in by legislation, not consumer preference. Third, de-dollarization is creating new monetary demand for silver. As emerging market central banks diversify away from U.S. Treasury holdings, silver is increasingly being treated as a monetary reserve asset alongside gold. India, Turkey, and several Gulf states have publicly discussed or quietly implemented silver accumulation programs. Fourth, COMEX inventory has no realistic path to replenishment before the March 27 delivery cycle closes. The vending machine is still short on snacks, and the line of people waiting to collect just got significantly longer. Now I'm going on the record. Screenshot this. By March 24th, 2026, silver will trade at or above $105 per ounce. The forecast data from the Economy Forecast Agency already targets $107.03 on that date. The structural supply deficit, the COMEX delivery pressure, the China export restriction, and the industrial demand floor all point to the same number. If you're watching this video after March 24, you will know whether that was right. Now let me give you the 3 scenarios and their probabilities, because no analysis is honest without acknowledging what can go wrong. Scenario 1, the breakout continuation. Silver follows the forecast trajectory, trading above $100 by March 12th and reaching $107 by March 24th. Probability, 60%. This requires no new policy intervention and continued delivery pressure on COMEX through the March cycle. Scenario 2, a sharp pullback before continuation. COMEX implements emergency rule changes similar to 1980, temporarily forcing liquidation. Silver pulls back to $72 to $75 before rebounding above $95 by April. Probability 30%. This is the scenario big players actually prefer. It shakes out retail panic sellers and allows institutions to accumulate at lower prices before the next leg up. Scenario 3, a sustained reversal. A rapid dollar strengthening event, coordinated central bank silver sales, or a global demand collapse pushes silver back below $65 for an extended period. Probability 10%. This would require simultaneous negative shocks across multiple independent drivers. Possible, but unlikely given current structural conditions. Now, let me speak directly to each type of person watching this. If you are holding physical silver right now, do not make emotional decisions based on daily price swings. Your metal is not going anywhere. The structural case for holding physical has only strengthened. Your only real risk is panic selling during a paper market-driven dip in scenario 2. Understand what you own and why you own it. That clarity is your protection. If you're actively trading silver with leverage, the next 2 weeks are extremely high risk in both directions. The $88 to $94 range forecast for this week represents significant upside, but also significant volatility risk. If you are using leverage, your position sizing needs to be smaller than you think. A 15% intraday swing is now a realistic single session possibility. Respect that reality. If you are sitting on the sidelines with cash and watching this, you are not late. But you need to understand that waiting for silver to return to $32 is not a strategy. It is wishful thinking disconnected from structural supply data. If you are waiting for a pullback entry, the scenario 2 dip to $72 to $75 is your window. Have a plan before that moment arrives, not during it. If you bought silver near the 2025 highs and are currently underwater on your cost basis, the data suggests patience rather than panic. Every structural factor that made you bullish is still intact and has arguably strengthened since your purchase. The question is not whether the thesis is broken. It is whether your timeline is long enough to allow the thesis to play out. Now here is what to watch in the coming days and weeks. Watch COMEX registered inventory daily. It is publicly reported and freely available. If inventory drops below 70 million ounces before March 27th, the delivery squeeze becomes critical. Watch the DXY, the US dollar index. A DXY move above 107 puts downward pressure on silver in the short term. Below 103, silver gets tailwind. Watch silver lease rates. If rates climb above 10% annually, it signals extreme physical tightness that paper market prices have not yet reflected. And watch China's export policy statements. Any further restriction tightening is a direct supply shock to Western markets within 60 to 90 days. There are 3 types of people watching this video right now. The first type is panicking, refreshing their portfolio every 20 minutes, making decisions based on hourly candles, and treating a 9% single-day move as either the top or a disaster. These people will sell at exactly the wrong moment. The second type is frozen. They know something significant is happening, they have seen the data, but they cannot pull the trigger on any decision because uncertainty feels like a reason to do nothing. These people will watch the move happen and regret the inaction. The third type is learning and preparing. They understand what COMEX inventory means. They know what a supply deficit looks like. They have a plan for each scenario. They are not gambling. They are positioning. You now have everything you need to be the third type. Markets have always moved wealth from the impatient to the patient, from the uninformed to the informed, from those who react emotionally to those who prepared structurally. Silver at 84.57. Today is not just a price. It is the market finally beginning to reflect a reality that the physical supply data has been signaling for 3 years. The people who study that data early are not lucky. They are prepared. Remember the question from the beginning of this video? Why did silver just jump nearly 9% in a single day? And where does it go from here? Now you know the answer. It was not random. It was not retail speculation. It was a delivery deadline, a disappearing COMEX inventory, an export restriction, and 5 consecutive years of supply deficits, all arriving at the same address at the same time. If this video helped you understand something that the mainstream financial media is completely ignoring, hit the like button and subscribe right now. Share this video with someone who still thinks silver is just a shiny metal with no strategic importance. They need to see this more than you do. And drop 1 comment below. Tell me, are you in physical, on the sidelines, or actively trading silver right now? That answer tells me exactly what video to make next. This is not financial advice. Always do your own research before making any investment decisions.